Hi, this is LeJune with LeJune Singleton LLC, Fitness, Health, Nutrition, and Wellness Podcast. Today, we're going to talk about how wealth, wellness, and health all ties in together. Because, of course, if your wealth is not in order, it affects your health and your wellness. So, I would like to introduce the founder, owner of Chedick Financial Group, Patrick Chedick. Thank you for joining me.
Thank you very much for having me. I appreciate you. How you doing today?
I'm good. How are you?
I am great. And I like your opening because, health and wellness is important because when you got $100,000 bill with the IRS, that can give you a heart attack. So that is important.
It definitely can. And definitely if your bank account is low and you have creditors calling you, hey, it puts you in stress mode. So can you give a background on yourself and what you do?
Okay, I definitely will. And I want to give you congratulations for starting the business and the brand.
Thank you.
Be more businesses out here, so we appreciate you. Keep it up. Can't wait to see you on some major network.
Me too. Let's speak that.
It's gonna happen.
Thank you.
Claim it. But no, so a little bit of background about me. All right. So how I got into taxes. Basically, I started working for DC Tax and Revenue Office as a customer service representative. And working there, every day you get a phone call, where's my refund? Where's my refund? Where's my refund? And we have the ability to go in, look at tax returns, look at every individual line, etc. And I started noticing that people had no idea about their tax return. And I'm talking about all different, from six figures to lower income. People had no idea, different races, sexes, everything. Nobody really knew nothing about their taxes. And then I'm seeing situations where people are paying $500 to do a tax return for Social Security income. It doesn't take that long. It takes less than an hour to do a tax return like that. The longest part is putting in your name, your social, and your address. That's the longest part of it. So just seeing that and seeing how a lot of people didn't understand taxes, it kind of led me to say, okay, maybe I need to start teaching this. And not not just doing it as a business, but also helping people understand their taxes. And that later led me to get a master's in taxation. So I'm not a CPA. My background honestly is in finance, but getting that master's in taxation was an amazing opportunity because it taught me about tax law. And the biggest thing about taxes, it's a mentality. It's not about the numbers. It's about a mentality. The numbers come after. You have to understand the law first, how to manipulate the law, take advantage of it, and then that's how you save on taxes. So that's kind of how I got into the business.
And in what area can you do taxes? Is it just in the DMV area or in all states?
No, all across the United States. Basically, any 50 states, they kind of almost all the same rules. Majority of states mimic the IRS rules. It's just about finding the little niches that one state might have, because you might have a state that's majority farmers or fishermen, and then they have certain rules for certain businesses. But across the 50 states.
Okay. And as you spoke about people not understanding taxes, also when it comes to tax forms such as your W-4 and your 1099, can you kind of talk about that? Because, before, they've actually changed now, but before people didn't know if they need to take an amount out or if they need to file if you're single one or zero. It was a confusion because there's no education on this.
Exactly. And hopefully I think I'm gonna start doing videos very soon because I'm realizing, yes, a lot of people still don't know. Let's start with the W-4. So we all know the W-4 changed. It was so much more easier before. We just put the amount of exemptions, 1, 2, 3, 4, 5, 6, 7, 8, 9, whatever. Now it's a situation where it's a dollar amount. And where that comes from is if you're a single person, the only thing you're really going to put on that W-4 is 1. That's it. Just representing yourself, period. Now, if you have children, you can mark yourself as single. Okay, because now you have to mark single, head of household, married, filing, joint, etc. If you have children, that's a little more different. So before, like I said, it was, you put your exemptions. So if you had 2 kids, 1 for yourself, and then 1 for each child. So 3 exemptions total. Now they change the rule where basically you're getting a direct dollar for dollar tax write-off on the taxes owed. So what that means is if you have 1 child, And right now the credit is $2,000 for the child tax credit. And this is pre the relief bill. So the relief bill changes to about $3,000 plus. But that $2,000 is coming directly off your taxes. So if you owe $10,000, that one child is going to reduce your tax bill by $2,000. Whereas before, your exemptions reduced your overall income, and then lowered your income. So if you owe $10,000 and you had one child, it would lower your income about, I think the last standard deduction was exemption was about $4,000, give or take. It would lower your income $4,000, but it wouldn't change that $10,000 plus so much. So now for people who have children, you basically put for each child you have, multiply it by the 2,000, okay? And I believe that's the second box of the W-4. So if you have 2 kids, 4,000. You have 1 kid, 2,000. 3 kids, 6,000. Now, for married couples, be careful. Do not, if you're married, only one, and you have kids, only one spouse should claim the kids. Because what's happening is that people are not thinking to themselves that, like, no, there's 2 of us. So what's happening is both spouses are putting an exemption for themselves, filing as married filing joint. Then they're putting the $2,000 for each kid there. Not realizing if you have 2 children and both of you guys put that number, they are now, instead of it being $4,000, it's $8,000 when it comes to your tax return. But you really don't have $8,000. You're only going to have $4,000. So a lot of people are ending up owing because they're mimicking their W-4s for married couples. So if you are married, the most important thing is one partner put themselves as just married filing jointly. And then the other partner, you do married filing joint with the exemptions. And to maximize your household income, I always look at it as like, who has the health insurance? Basically, whoever has the health insurance on theirs, you want to just take the married filing joint and then the other person take that, because that maximizes, the other person will now maximize income into the household, basically. Okay. If y'all both have insurance, then it is what it is. Yeah.
So what if it's a household that has more than 2 kids? So how would that work?
You just keep multiplying. If it's, you still try to focus on one side. Now let's say for instance it's 4 kids. Now in a situation like that, yes, one partner can do 2 kids, the other partner can do 2 kids, so that you can maximize that take home depending on the income. Because if you are partners, and let's say one partner makes 100,000, the other partner makes 40,000. Okay, you would want to maximize the 100K income, basically, so that will lower the tax liability at the same time you bring home more money throughout the year. So just all of it depends on your household and your finances. But definitely talk to your tax representative so that you know your household and they can kind of coach you through what's the best fit for your household to maximize your income and not pay too much taxes.
And what are some of the misconceptions that you get from your clients when it comes to taxes?
1, to get a refund, you have to pay some money in, okay? That's the biggest one of them all. It's like going to Best Buy and you walk in there and say, I want a refund for something you never purchased. They're not going to give you any money. You have to purchase something first to get a refund. So that's one of the biggest misconceptions. Now, don't get it wrong. We do have refundable credits as taxpayers. And the biggest ones is going to be the earned income credit, the American Opportunity Credit for those who go to college. And then there is the additional child tax credit. Okay. Those credits are refundable. So if you made $15,000 last year, you have 3 kids, you can put 0 for your withholdings and take all that $15,000 home, because when year end comes, you're going to get the earned income tax credit. So automatically, that $15,000, first off, you have standard deduction as a head of household, $18,000. That wipes out the 15. Okay. Then turn around, being lower income, you now get the earned income credit for each child. And since you have a 0 tax liability, you might get the additional tax credit because you don't have a tax liability for the child. So that money now comes back directly and you paid nothing into the government, basically. So again, the American Opportunity Credit, if you go to college, that's a refundable credit. The earned income credit, refundable credit, and then the additional child tax credit, that's another one. So those are 3 refundable credits. The next thing too, businesses don't get refunds. you have to pay estimated taxes, okay? And starting a business, because a lot of people start businesses just like, oh, if you start a business, you can maximize your refund. No. The IRS knows you're going to have losses in your first few years. They expect that. But if you're 10 years of losses, to them, that is a hobby. Because why are you in this business for 10 years and every year you're taking losses? They expect you to break even at some point. Now, don't get it wrong. Everybody's mad about Trump not paying taxes. No, there are certain parts of the law that allows you to have consistent losses, net operating losses that carry over year. So, there's other things like depreciation that allow you to basically knock off income. But that's another thing. Like, so if you own a business, you have to pay estimated taxes if you want anything back. There's only certain special credits, but no, you have to pay something in. That's another big misconception right there, for sure.
And so you spoke about students. As we know, some students go to college and they get part-time jobs, and then they want to file taxes, but they realize, oh, my mom or dad put me on their taxes. Can you talk about that? Because that actually happened to me 1 year.
That happens to a lot of students. And it's funny, too, because of the stimulus, there were so many kids pissed because they thought they were getting a $1,200 check. And it's like, nope. Sorry. So, the IRS is realistic. They know kids have summer jobs, but common sense, they are not taking care of themselves. They know that. And then also, too, the average kid makes under $15,000 that year of working. Even when you're in college full-time, even when you're working part-time, you're only working so much. So as a parent, you can still claim your child. Even though they worked, they would just have to make sure that when they file their tax return, they file as a dependent, okay? If they don't, somebody's return is going to get rejected, and it's going to be theirs because they're on yours. Whoever files first wins. Whoever files last loses. So if your child files first, you lost. If you file first, your child loses. So, and for parents who you're paying for college and you're helping your kid pay for college, you better file first because you deserve that credit back. So it just all kind of depends. But no, you can still file your children even though they're in school. It's just all about the income. Now, don't get it wrong. If the kid makes $50,000 a year on YouTube, no, you can't do it. And then for the college student, unfortunately for you, when you file as a dependent, you lose all the credits. So you're not going to get the American Opportunity Credit. You're not really going to get much benefits because you are a dependent. So they're not going to give you tax benefits for somebody who's living off of somebody else.
That definitely makes sense. So can you give a detailed description of what your role is as a tax preparer, planner, and business consultant for clients?
The best word is advisor. So we know common sense. We don't expect you to know the tax code. We don't expect you to know every update, law, etc. So our job is to change your mentality. Because most people just think, go to work, file taxes, period. No. There's so many different things that go on, especially like the biggest issue I always see is people pulling out their retirement. People pull out $20,000 from their retirement and they say, yeah, just take 30%. Not realizing that's 30% of that $20,000. But you make $150,000. And that $20,000 now, on top of that $150,000, that's a tax liability over $24,000. Get my point? So that little measly, $6,000 you took out is not going to do anything because you put yourself into a higher bracket sometimes, depending on the situation. So, it is our duty to consistently advise you guys. You should not be talking to your tax preparer at year end. You shouldn't be talking to your tax preparer when it's time to file. You should be talking to them all year round because January is when it starts. Now, if you're just a regular employee, W-2, that's cool. You don't really have to talk to them that much. But if you're going to make a financial decision that can affect your taxes, reach out. When it comes to consulting, well, for me personally, when it comes to business, I just love business. So when it comes to my clients, we can talk business all day long. I've started a few businesses. I understand operations. So, it creates a great situation because We can discuss growing the business at the same time as you're growing the business. These are the tax benefits in growing this business so that you're prepared, like when you get that first 6-figure check and it's coming soon, you already know, okay, I can put up to 50 something thousand into a self-directed 401k. I pay a mortgage, and then my mortgage is not enough for itemized deductions, but I can take a piece of this mortgage and put it towards my business because I have a home office, basically. So it's just trying to find those little things that most people don't think about, like right now, as me and you talking, your internet is a tax deduction, basically, because you're paying internet every month and you are using that to have this discussion. So a portion of your internet is now tax deductible.
Okay. And what are some of the risks that individuals take by not filing their taxes, and how much time or how many years do they have until they can file their taxes?
So they can't?
They can.
Okay. No, the can't only applies to refunds. So you have up to 3 years, starting from the due date, not the end of the year, but the due date. So a prime example, I think right now we're in 2021. So I believe 2017 taxes is the last year to get your refund, because they were due on April 15th of 2018. So always remember, April 15th is the starting date of that 3-year period, okay? That's the first thing. Now, what do you risk? Jail time. Don't believe me? Ask Lauryn Hill, ask Fat Joe, ask Wesley Snipes, ask Al Capone. I can go down the list. That's the biggest thing is jail time. And no, don't get it wrong. Most of the time, you're not going to get jail time. It's really more about... one time you get jail time is when you lie on there. When you lie and you make a lot of money. So somebody who makes $100,000 is not going to send you to jail over you not filing your taxes. But the biggest thing you sacrifice is negotiations. When you don't file, they don't negotiate. When you don't pay them, they don't negotiate. That's the last person you want to owe is the IRS. They are nothing compared to your mortgage company, student loans, nothing. They are vicious. When they come for you, they come for you. So you never want to dodge them because, again, when they realize that, like, okay, you're trying, even if you owe, just file and work with them because they'll understand that, like, you have bills. They understand that, they're everyday human beings. So they'll work a payment plan that meets your needs. And let's say, for instance, you can't pay the payment plan, give them a phone call. Say, hey, I just fell on hard times. I need to, figure this out. And I've had somebody before who owed, I think it was over 30, 40,000, something like that. And they only made 20-some thousand a year. The IRS canceled the whole bill because they realized after seeing so many tax returns, she's never going to be able to pay us back, making 26,000 a year. So, but at least she was compliant with them, talking to them, and they just basically sent her a letter and said, no, you're canceled. And over the last 5-10 years, over the last 10 years, she's been receiving all her refunds every year. They haven't took one away.
Nice.
Yeah, so if you're low income and you owe a really huge bill, reach out to them. They might cancel it because they understand that, like, there's no way they're ever, because the interest and penalty, and just FYI, not paying, I'll do the math for you real quick. Let's say, for instance, $10,000, 25% penalty. Okay, so it's 5% every month up to 25%. So that's $2,500 on top of this. Now we're at $12,500 by what? October, give or take. September. Then turn around 10% interest. That compounds. So do the math, 10%, that's $1,000. Now we're $3,500 just within the first year. So imagine you owe 5 years. Yeah. And I'm trying to tell you, I've seen bills double easily. And trust me, that interest does not stop. The penalty you can ask to waive, but the interest does not stop. And I'm trying to tell you, it's a beast. I wish sometimes our banks paid us that money.
Oh. Okay.
We all be rich if the banks paid us what the IRS takes from us.
Right. Okay. So I have a question for you. I've had friends that experienced this where their identity was stolen and a person filed taxes and they weren't able to file for years. So in situations like that, what can someone do? Because of course, you're like, okay, well, I can't file my taxes. Somebody already filed taxes on my behalf and getting that money.
Mm-hmm. You have to contact them because that happens a lot, unfortunately. It happens a lot. So in those situations, you have to contact them, let them know that, hey, somebody took my identity. They're going to let you know what to do. Because I haven't had anybody under me yet have that happen while under me, so I don't really know the whole entire process. But basically, you have to reach out to the IRS, let them know. And if you go on the website, there is a department for that. So if your identity has been stolen, and then you reach out to them, let them know what happened. What they'll do is they'll basically start an investigation. You submit your real tax return, and then also too for safety purposes. Like with my system, we have to now put your driver's license in there, information. Okay. So if you're worried about your information being stolen, consistently, tell your preparer, hey, put this in. Because that'll let them know that, like, hey, I'm putting this in every year. So if this person didn't put it in, it's a problem. And then what they'll do is they'll send you a PIN. So this PIN will be sent to you every year. You just have to make sure that your address is always updated on your tax return. Okay, because they send the PIN in the mail, and that PIN basically is what has to be used for your return to be submitted. If that PIN is not on there, it will not be electronically filed, basically. And trust me, I know, because I have a few clients with PINs, and if that PIN is not correct, reject it until you have that PIN on there. So that's a safety point that they're using, and hopefully, they'll start stepping up more and better technology where they can have, other ways of like validating who you are.
Okay. And speaking of identities, of course, we saw last year when it came to the first stimulus check that people were going back to their preparers who they hadn't got their checks because the preparer got the check. So what advice would you give an individual to make sure the person they're working with is a legitimate person?
So there's two sides to that. I'll give you the legit side and then the theft side. The legit side is from working at DC, I got to see everything. So when you have companies like H&R Block, Intuit, all these companies, Jackson Hewitt, so the people who get those refunds, refund advances. When you submit your information, once you get the advance, automatically H&R Block is going to have your social, and then it'll be a number behind it. And that's how we knew it was legit, because they would always have the person's social and then their bank account information, H&R Blocks. So I automatically knew, okay, that's H&R Block, that's legit, we're good. Whereas the theft is like going to a regular preparer like myself, just using myself in general, and then basically I say, well, yeah, you're gonna get back $5,000. And I'm like, okay. And then I will plug in my bank account information. You'll never see the money. I've loaded up, I'm gone. Because it's really, I'm not gonna lie to you, it's a scam, because a lot of people can set up shop in front of, let's say, a housing area. And they'll put they'll set up shop out there, and they can do over 100 plus tax returns in one day. And then by the time everybody catches on, that person's already gone. So the biggest important thing to do is go over your tax return with your preparer, okay? You need to make sure it is your bank account on the back of that tax return. Sometimes it won't show the account, it just have X's, but you accessing the system. You say, hey, take a picture, make sure it's yours on there, because you do have some preparers that will do that. Also, too, look at your return to see what you're getting back, because our systems allows us to make multiple payments. So if you're sketchy, and I probably know there's a high chance you're not going to pay me because you only got back $50 for your refund and you make $26,000. Let's say you got $300, but you make $26,000 a year. You're not paying me. High chance you're not going to pay me. So I can automatically, not everybody, but some people,
right?
I can automatically take out my fee from your refund. So if you're getting back $300, I can put in my fee, have that refunded, sent to me directly, and then you get the rest of the money. So you have to watch out for that, because the reason why you want to look at your tax return and look at the dollar amount on the refund line, because a tax preparer can tell you, hey, you're getting back $2,000, when really you're getting back $4,000. They're only sending you $2,000 and they're keeping the other $2,000. And also, I think there's a max fee a preparer can charge. I think it's $900, somewhere around there. And that comes from because before, when people were getting the earned income credit and large refunds, tax preparers were charging them large astronomical amounts because there were people who are getting back $10,000. So they knew if I charge somebody $2,500, they don't care, basically. So look it up. I can't remember the exact number, but there is a certain fee up to a certain amount that we can charge based on certain tax returns. Now, don't get it wrong. If you are a C Corp or an S Corp and you have $1 million in fees, no, we can charge you whatever we want. Okay. But when it comes to your refund for lower income individuals, no, there is a certain limit that a preparer can only charge you because they were basically killing people in the past.
Wow. So what do people need to know and need to be educated about when it comes to filing taxes? Because, of course, most people are like, okay, well, I just want to get my money back from what I put in. And then most times people have to pay. They don't understand why they have to pay, especially if you're filing single or if you got kids, you got to pay in because not enough taxes came out. So can you kind of talk about that?
The best thing is to understand that it's human resources, okay? It's really all about the system that your human resources has. So if you have ADP, if you have Intuit, whoever, QuickBooks, whatever, that's the biggest thing. It is a mathematical equation for when it comes to withholdings and your taxes. So what people have to understand this. If you say, let's say when you get a refund back, or you owe, let's say in the range of $500 on both sides. All that means is your HR department is accurate, basically. Because technically, it's supposed to be zero. If you make $100,000 at year end, if withholdings is perfect, you don't get a refund, you don't owe. That's it, right? And that's just for the average W-2 person. Now, when it comes to somebody with children, when it comes to somebody who owns a home, has a business, no, that's a little more different because now you have all these different elements and credits that are going to come in. So it's a little more harder to gauge. So the most important thing to do is do an analysis of your tax return. Look at your last 3 years. You know, I have some people where 5-10 years, they're going to have the same refund every single year because they have the same job. Nothing changes. Where some people, you know, their income has went up, so their refunds decreased. Or their income has went down, and then basically like, you know, they can use the money. So instead of paying it, they need to just keep it throughout the year. So the best thing you can do is do an analysis on your tax return. Talk to your tax preparer. If you're not good at math, talk to your tax preparer. You should not be a single person with standard deduction and getting back $3,000, $4,000 at the end of the year. That means your HR is wrong. And it's on the flip side, if you owe $2,000, $3,000, $4,000, $5,000 a year, your HR is wrong. Now, if you have claimed one and you owe every year, drop it to zero. If you still owe and you drop it to zero, just do the math. If I owed $2,000 last year, divide that by 26, which is pay periods, okay, biweekly pay periods. If you work monthly, divide it by 12. If you get paid weekly, divide it by 52. And then what you do is you say, okay, I'm zero. And also on the third part of the W-4, you say, hey, I want to withhold an additional $25, basically. And then come year end, hopefully you should not owe or have a small refund. And I have to come back. When we talk about W-4, they never talk about 1099s. Mm-hmm. Can I jump in on 1099s real quick?
Yeah. Okay.
1099s. You never get taxes withheld. They're never going to withhold taxes. To business owners, please remember we now have the new 1099 NEC, Nancy Edward Carl form. It's not the 1099 miscellaneous anymore. They changed the form directly for these direct payments. So make sure when you are filing every year, 1099 NEC, not the miscellaneous anymore for when it comes to non-employee compensation contractors. But when it comes to 1099s, the biggest thing is this. Understand what you're allowed to write off, okay? Because a lot of people don't realize, even though you have not claimed yourself as a business or have not got an EIN, once you're 1099, you're technically considered a business, okay? Because you now are controlling what you're doing. You are a contractor to them. You are not an employee. So everything becomes a write-off. If you drive to that office, write off your vehicle, okay? If you are working from home, your rent, your mortgage, everything becomes, anything that you spend in your house that helps with that business becomes a write-off. If you renovate your house for an office, that renovation can be depreciated into the business. So, and then like your tax preparer, if you pay your tax preparer, that's an expense of the business. So make sure if anybody with a 1099, understand that you can write off anything that deals with that business. You bought a new laptop, write off, okay? You went to go meet somebody for lunch that dealt with that business, write off, up to 50% for meals. But that's the biggest thing with 1099s. And then also too, if you're a person that gets 1099, let's say you make $100,000, pay estimated taxes. Okay, we cannot, and this is DC. I cannot make $100,000 disappear. You don't have that much in rent. You don't have that much in vehicle. You don't. Okay, so if you make a large sum in 1099, please estimated taxes, because you're gonna have to pay self-employment tax, which is 15%, and that's the biggest killer that a lot of people are not aware about. That basically, and if you look at your W-2, that's basically box, I want to say 5 and 7 of your W-2, Social Security and Medicare, basically. And people don't realize as a 1099, you're not just paying ordinary income tax, you're also paying the self-employment tax, which is 15%, because you got to pay the employer side and the employee side. Whereas your W-2, it's just the employee side.
Okay. And speaking of taxes, here in DC, Maryland, Virginia area, individuals work in different places. Sometimes they overlook the fact, and it could be a mishap on HR where they complete the wrong tax form of that state. Can you talk about that? Because that happened to me. I lived in Maryland, and HR ended up giving me a Virginia form, and I was new to the area and had no idea the difference.
Right. It happens all the time. So you pay taxes where you live. Okay? If you live in Maryland and you have a Maryland license, you pay taxes in Maryland. It doesn't matter if you work in Virginia, it doesn't matter work in DC, and vice versa. Okay, and then DC, Maryland, Virginia, they have a pact with each other that basically they don't tax income from individuals from the other states. You can cross all these lines, you're not going to get taxed. Maryland has a relationship with Pennsylvania also, the same thing, where Maryland residents go to Pennsylvania and Pennsylvania come to Maryland. So if you do have that situation where it's end of the year, and please look at your W-2, look at your pay stub, very important. Because when year end comes, it's just an extra headache. So what happens is that if you do land in that situation, contact your HR ASAP, have them change it over to your state, and then you basically would have to file a non-resident return with that state. So say, for instance, like you lived in Maryland, they withheld Virginia. So basically, you would have to file a Virginia non-resident tax return, and then you have to file a Maryland tax return, okay? And in those situations, you want to file very early, because you want to give Virginia enough time to process the return. And what will happen is, let's say, for instance, you made $100,000 and they withheld $20,000 to Virginia. What will happen is okay, Virginia will process your non-resident return and send you the whole $20,000 back. Maryland, on the other hand, you owe. You then have to take that $20,000 and then pay Maryland their money, okay? And now let's say, for instance, you owe Maryland $18,000. All you have to do is send them 18. That other 2,000 is yours, okay? But most importantly, please, when you get that money, please pay the other state. I've seen people do it so many times where they do the non-resident return, they get back $6,000, do not pay the other state. It's not worth it, because whatever you spend on that $6,000 is not going to add up to the penalties and interest that you got to pay back the other state over the years. So please, when you receive that money, send it back.
And can you kind of explain the difference from state taxes and federal taxes? Because, of course, people don't know the difference in that as well.
State taxes and federal. That's a good way to put it. Okay. Federal taxes. So federal taxes pays for your military, your certain, not all your highways, but certain highways. Your congressmen, your government agencies, and your federal taxes will always be higher because the federal government also supports states. So technically, you're like almost double taxed in a way. So your federal government tax is always going to be higher because that's based all the programs that we have. SNAP programs, housing development programs. All these different programs are funded by the government. Your house, if you bought your house and you got a HUD loan, Fannie Mae, Freddie, that's the government. That's what your taxes are going to, helping America. And you have to understand the biggest thing too is, this is the biggest thing you can take from this whole conversation. The tax code is set up to benefit people who are benefiting America. So if you are creating jobs, if you are helping lowering smog, if you are creating situations that's creating tax for states, which is like owning a home, the law benefits you. Reinvesting in your business and growing your business, that's how the law benefits you. As an individual, it benefits you with like things like solar, because the world's changing and we need to stop global warming. Doing things like, buying a home, because now when you buy a home, the state has more income. And with the state having more income from your property taxes, then turn around, guess what? The government, they're not going to need the federal government as much. So that's why you get to write off your house taxes on your tax return, because you are helping America by owning a home, and then also home builders, etc. So that's the biggest thing. But now state taxes is for a lot of your day-to-day stuff. So your schools, your roads, your government officials, your local programs, that's what the state tax level is for. And the state tax is always going to be cheaper because they're only focused on that state, and that is it. Whereas your federal dollars go across the entire U.S. So if you live in Maryland and you file a federal tax return, that money split across 50 states. Whereas Maryland, no, you're paying 8%, well, 5% for the state and then 3% for the county, basically. Depending on the county, it could be 2%, 1%, etc. I just found out Arundel pays less than Prince George's in Montgomery.
Oh, wow.
I feel something. They're right next to each other. Like, just cross the line.
Right,
it's like you
right.
literally save yourself like a percentage point on taxes. Not a whole percentage point, but like a half percentage point, something like that. But yeah. Sorry, had a moment.
So what do new business owners need to know? Because, people start businesses, they don't do the whole registering their business, the taxes, anything like that. They're posting stuff on websites to sell. So what would you say in regards to that?
The biggest thing, know your entity. One, an LLC is not an entity, okay? What I mean by that is an LLC is kind of like an insurance in a way, basically. It's basically splitting you from the business, okay? So if you were to get sued, it doesn't come back to you, okay? But just because you're an LLC, if you're a single member like me, I'm a sole proprietor. So I'm a sole proprietor LLC, okay? And don't get me wrong, you can be a sole proprietor without an LLC also and have an EIN. Let's see, a partnership. You can be an LLC, but you're being taxed as a partnership. And once you have one other person, that's it, your partnership, okay? Unless it's you and your spouse, and you can elect out of partnership because it's you and your spouse. Same thing with an S Corp. LLC, taxed as an S Corp. C Corp. Now, the biggest tax savings is the S Corp. The C Corp too, but the C Corp is a lot more harder structure. And that's for when you've really grown the business and you have way over $1 million in receipts. And the S Corp is the best structure because for most small businesses, because if you make $100,000, right? Now let me take this back. If you have to pay yourself a wage, and once you pay yourself that wage, you have to pay self-employment tax and other things on there. But let's say, for instance, you have $100,000 profit on that business, okay? That business, that $100,000 only pays your individual income tax. That's it. You don't have to pay self-employment tax. So that's a $15,000 savings, literally, okay? Whereas me as a sole proprietor, if I have $100,000 profit, I got to pay $15,000 on top of my income tax and it'll be about $35,000. Whereas like the person who has the S corp might only pay $22,000 on that money. Don't quote me exactly on the dollar amounts, but so when it comes to your business, also the biggest thing too is start at the state level first. What I mean by that is whatever business name you have, when it comes to being an LLC, just because you went on the IRS website, got an EIN and put Steve Johnson LLC does not make you an LLC. You have to go to the state website first. DC is DCRA, Maryland is SDAT, and Virginia, I think, is the corporate office, something like that, Virginia corporate office. And what you have to do is you have to go on there first, look up the business name first to see if anyone else is using that name. If no one else is using it, you are fine, go ahead. Then you register with the state for the LLC. For sole proprietors, no, you can just go straight to the IRS because you're not an LLC, so you're fine. But for people who want to be an LLC, S Corp, C Corp, partnerships, and under LLC statute, you have to go on the state site first because you have to lock in that LLC. And when you go on the state site, a lot of times they're not going to ask you for the EIN, okay? But make sure you do that because if you go straight to the IRS website to get the EIN and you put LLC, this does not make you an LLC. And most importantly, too, is every year you have to file an annual report with your state, which I call the screw you tax, okay? You have to pay them anywhere between $125 to $350 a year just to maintain your limited liability ownership. Because if you do not pay that, you are no longer an LLC and you're disregarded. So if you get sued that year, you have no protection. Okay. Trying to think, I had something else to say. LLC. Oh, another big thing too is when you're registering as a service-based business, like me as a taxpayer, I'm a service. I'm doing your service also. You don't need a sales and use. You don't need a withholdings account. You only need a withholdings account if you're going to pay payroll. Basically, if you're going to have a W-2 employee, that's when you set a withholding account. Sales and use, that is for people who are selling products. Okay. Now, like even like you, let's say for instance, you know, you're doing your health and wellness, and now you have merch. Okay. So you're selling merch. Yes, you're gonna have to set up a sales and use account because now you're selling merchandise, and you live in Maryland, so you have to pay Maryland sales tax. Whereas if it's a different state, based on that state law, you might not have to pay sales tax up to a certain amount of dollars that you are selling. So make sure to not over-register unnecessary accounts because they're going to think you have these accounts and they're going to ask you questions. Then also, for those who are going to have employees, you have to register the unemployment office also. So the best thing to do is go through a service, the ADP or God, why do I keep forgetting the other company? I feel like I'm giving ADP all the money right now. I'm like, there's another company, I'm like ADP and somebody else. I cannot think of the top of my head right now. So it's the best thing to just go through a payroll service because it's a lot easier. Paychecks, there we go. It's a lot easier. They manage it because the one thing people don't realize too is most tax preparers do not do sales and use and do not do withholding tax. That is a whole different beast in itself. And majority of large accounting firms, they literally have departments strictly for that. Literally. So trust me, you want to go through a service because payroll is a tricky beast in itself. And you want to make sure that you're going with somebody that's doing all of it. Don't try to save money and be like, oh, I have my tax preparer do everything because the average tax preparer does not do payroll. I can tell you that right now. And if you want them to, you're going to be paying a pretty penny monthly.
Okay. And speaking of course, when people start business, first thing they consider is, oh, I got to pay myself. So what are your thoughts and how, when you work with clients that start a new business, what advice do you give them when they say, oh, okay, well, I'm going to pay myself 50% of what I made or 75% of what I made?
When you start a business, if the first thing you're thinking about is paying yourself, you have a high chance of failing. I'm being honest. I'm not saying you're going to, but I'll put it like this. Every corner store in America could have been Walmart. Period. Never think about paying yourself. If you want to start a business, your best, if you're confident, your best situation is you save up some monies, at least 6 to a year, month worth of bills, or you pull from your 401k if you have one when you're ready to start the business. You don't pay yourself. I did that stupid mistake early where the money's coming in, the money's going out. Well, guess what? At the end of the year, I got to pay $2,000 for the software. So now, in that first 2 years, I'm only making so much money. So I got to come up with this $2,000 now for this software. You have to realize the most important thing to do is reinvest into the business. You want the business to grow. If you're thinking about paying yourself, you're going to fail because guess what? When something does come up or you want to grow, you don't have the money, basically. So now, guess what? You're going to have to keep finding tactics now to like keep harassing your clients. Whereas, if you manage your funds correctly, don't get it wrong, you should pay yourself, but don't make it something consistent, basically. Because I'm realistic. Some people quit their business, quit their jobs, and they have to use that money that they're making to pay their bills. And again, that is a very tough and tight situation. Research, what are they called again? Payroll loans, things like that, because they do have bridge loans that do help you as a small business, basically help you pay payroll at the same time you still get to reinvest the money. So to me personally, never think about paying yourself. Never. If you want to be successful, you want to grow, focus on making the business better because I promise you, the more you reinvest, the money comes easier. And then you'll be paying yourself like it's nothing in a little bit.
And you mentioned retirement benefits. As we know, many people, you get in financial bonds, and the first thing we do is go to our 401, 403 benefits, which is tax. Can you kind of talk about that and the pros and cons of doing that?
It's always a con. Okay. I do understand we have medical bills. I do understand we all, I'm not considering lie. I've tapped into mine before. But the difference between me and most people is every dollar I tapped into, I can make that back, basically. So somebody who's just a W-2, you have no entrepreneurial spirit, no hustle, no nothing. I don't advise you to do that because when you need that money 30, 40 years down the line, guess what? You're outdated now. The way technology is moving, you're outdated. So that $30,000 you took out years before could have been $75,000, $80,000 in your retirement account by the time you retire. So, when you're 65, 70, you're not getting a job that easily anymore. It's going to be very difficult to find a 6-figure job or a job that's going to give you real money. And everybody knows Social Security is a joke. And we are living longer. So, I've seen it already where like I had people, I managed people's money and she had $380,000 when we first started 5 years ago. It's down to almost, I think, a little under $100,000 now because she's taking 15K out here, 10K out here, 20K out here. And I'm like, yeah, you can't keep doing this because she knows that she has the money there instead of saying like, let me rough it out. Because when we don't have the money, we figure it out. When we know the money's there, we take the money out ASAP. So I don't really advise anybody to do it, but I do understand that you need to do it. But if you do it, at least when you get that next new job or the job you're at now, increase your contributions. Especially if your job is paying a good amount and they're paying 5%, 10%, they're matching, increase it. So that even though you might not fully replenish it, you're at least replenishing a good amount. And if you can, go for the loan instead. At least with the loan, you don't have any tax hits with the loan. And then turn around, the interest that's on that loan goes back into your account, basically. So it's a great way to kind of like take that money out, but at the same time, not take a tax hit and not, reduce your income later for retirement.
Okay. And speaking of businesses, of course, we've had several business loans and business grants that's been offered to companies. What do you recommend for new businesses? They don't have any employees, they just starting up and they see, oh, I can get a grant, oh, I can get a loan. Can you kind of talk about that?
I'm gonna take a deep breath first because that's what's going on right now and it's driving me nuts. Okay. Have a plan for the money. The one thing I'm realizing is people are are trying to get $20,000, $30,000. For the fact that you're calling me and asking for a Schedule C, that lets me know you don't know your money, you don't have any money, you really don't have a business, basically. So, in common sense, if you have nothing to do with that money, every worse option is accessible faster. Amazon's right there. Macy's is right there. Bergdorf, everything is right there. I promise you that $30,000 is going to be gone before you come up with your business idea or what you're going to do with it. So, and even for the business owner who's already in operations, know exactly where every penny is going to go, because your debt to income ratio is about to go up, especially if you got a loan. So it's not going to be as easy to pull loans later if your income is not going up at a fast pace. And every business owner, I promise you, you think you're going to make a certain amount of money in 5 years. Yeah. And then you realize it doesn't work that way. And then sometimes you might have a great year. Some people, I've seen people come out their first year 60, 70, 80, $100,000. But that following year is not the same. That following year might drop. So always understand that expenses will always be there. Income won't. And if you're going to pull money, if you're going to get loans, you're going to get grants, make sure you have something planned for it that you can reinvest if it's capital expenditures, if it's hiring new staff, whatever it can do to make you more money. Don't just pull the money to do it because you're not going to be paying back a loan that, you know, there's an extra $300 or $400, $500, whatever that amount is, that's not making you money. And then also, too, you have to look at your interest. If you're like, I'll use student loans, for example. People hate student loans, right? Mine are $143,000 a year, okay? Look at this like student loans. If you took out $143,000 a year, like me, and you're paying 6% on that, okay? Well, do I make more than that? Yeah. So technically, you know, I've been out of school for what, 6 years? I've made my money back. I'm exceeding that 6%. I'm making my money back. Well, they're charging me 6%. I've made my money back because I make X amount of dollars a year, etc. So when you're getting that loan, if you're taking out $30,000 on, let's say, for instance, 10%, are you returning more of that? Because if that loan is costing you 10% a year, and then you're only making 5% return, you are technically just operating a loss, basically. Mm-hmm. So you don't want to be in a situation where you're taking out loans and then this loan is costing you more than what you're making. So always look at it as like, all right, if I'm going to take out $30,000, I should have a projected plan that my revenues are going to make this back within X amount of years, and I'll break even on this loan. And then you want to do that because that also does build a relationship with the bank. So if the bank sees that, yes, I've paid this loan back in a timely fashion manner, boom, they're willing to give you more money.
Makes sense. Okay. So what advice would you give business owners when it comes to finances or just anything in general? What advice would you offer?
To business owners, keep track of your records. Know how much you're making, know how much you're spending. Don't wait till year end. Because when year end comes, we can't do anything for you on December 31st. Okay? The only thing we can do is you can, you know, if you have a solo 401k, you can do the employer side, you know, in the new year, you can do an HSA, little things like that. But it's in your best interest, either you do a quarterly report on yourself or have your preparer, whoever around you is a financial person, do it, because you want to see what you're making. You want to know that, like, okay, when year end comes, will I owe, will I not owe? Also, have a conversation with your preparer about the provisions. Talk to your tax preparer about your business. This is the business that I am in, okay? What benefits can I get tax-wise, or what new credits came out that I can take advantage of, or, you know, so, and don't get it wrong, every preparer is not going to know. And that's another thing you have to do your research on. Like right now, the IRS is trying to push every person to register because you have a lot of ghost preparers who will do your tax return, but they will not put their names on it, okay? And once you're registered with the IRS, like I'm registered with the IRS with the, it's called a PTIN. So if you look at your tax return, at the bottom of your tax return, you should see my name, my business name, my name, and a PTIN number, okay? That is letting you know I am registered with the IRS, okay? So if I screw you, I'm screwed, basically. Okay, and don't get me wrong, every preparer lies a little bit. It's a fact. But if you got your tax return done by a preparer, and you look at the bottom and you don't see any name, any pizza, nothing, that is a ghost preparer. And if something happens, the IRS is not going to care. They're going to blame you. That's it. And that's another big thing. It's very important. You as a tax preparer are responsible for the tax return. Okay? Even if you say, well, my preparer prepared it. Nope, you're responsible. The only time the preparer ever gets in trouble is when it's like when they straightforward lie on your return. Basically, where like you provided everything correctly and they did it incorrectly. That's the only time when we're in trouble, but the IRS puts it on you. So the biggest thing is understand your taxes, because if you don't understand your taxes, you're going to be faced with multiple things. There's AMT, there's a net investment income tax. There's these different taxes that you have to understand. It's very important. And I know most business owners, common sense, you don't know nothing about taxes. It doesn't make sense. But you want to at least be a little familiar about it, okay? And the biggest thing, too, is your preparer should be educating you, okay? If you are a business owner, you're paying for a service. Take advantage of it, okay? And sometimes you might have to pay a little extra, yes. But you want to pay attention and also to try to do a year-over-year analysis on your taxes. Is my income tax rate going up? Is it going down? Because when you start seeing how much you're paying, you can start planning on how to reduce it, basically. So yeah, know what's out there. Talk to your preparer. Take advantage of your preparer. Take advantage of Google also. That's your best friend. So definitely do your research.
Okay. And what advice would you give to taxpayers? Because, it's tax time, we like to spend our money. So what advice would you give to taxpayers?
The taxpayers who like to spend their money. I always say, for myself personally, look around your house and see where'd your money go. So what I mean by that is, like, if you look around your house and you can't point to two things, that's like, oh yeah, like this, not this TV, but I remember some years ago, I bought a TV, lasted me X amount of years, okay? And if you are walking around your house and you're just like, no, I have nothing to show for this tax refund every year that I'm getting, because some people are getting $5,000, $6,000, $7,000, $8,000, $9,000, $10,000 year over year, and they have nothing to show. Okay, the biggest thing is same thing as a business person with a loan. Plan your refund. Yeah, you might have to. I understand everybody's situation is different. Some people, please stop using your rent money to pay for Christmas gifts. Okay, please. Please, because the IRS has been moving tax returns back every year. So it's no more getting it quick. But I just think the biggest thing is just kind of like having a plan for your refund, basically. Spend a little bit, there's nothing wrong with that. But also try to put a little bit away. Especially if you have kids, try to put it in a 529. That's a tax write-off. Try to put it towards your own retirement, etc., or pay extra on your mortgage, something important, use it for a down payment, because you don't want to just keep spending that money. And to be honest with you, it's an addiction for some people, where they get these refunds every year and they're just like, and you have to break that addiction, because if you never do, you're never going to advance in life, because I've seen a lot of people where they really don't advance in life because they know, like, I'm gonna get this refund, and then they're blowing that refund over and over again. For individuals, if you're owing every year, please talk to your HR department, talk to your tax preparer. I always tell people, it's like your withholdings is giving the government a loan for like a year. And then once you start paying penalties and interest on any extra money that you owe them, you're literally giving them free money. All jokes aside, the second you owe the IRS, and that first penalty or interest, because the part that you owe them as your American duty. But once you start kicking into penalty and interest, you are literally taking money out of your household to give to the federal government. And trust me, I've worked for the federal government. They're just burning through your money. Okay? So you can take that same money and keep it in your household. You don't want to owe. So tax planning is very important. If you're having a child, if you're buying a home, because especially if you're having a child or buying a home, your income is going to be a little more tighter. So instead of you getting back that $3,000 refund at year end, figure out the math. Bring that money home throughout the year, basically. Okay? And it just makes more sense because, again, you can use that money to pay bills. You use that money towards your kids' school, fix your house, increase your property value. So it's really all about, another big thing too is taxes need to be a part of your wealth plan. Okay? I seen it a few years ago where their father died. They sold the house like 6 months out before he died. Basically, if your parents own a home, let them die first. Don't sell the house. Because when you sell the house, and especially if it's like your parents own more than one house, okay? When it's their main home, if they sell the house, there's a tax exclusion. If they're married, up to $500,000, where they can write off. If they are single, $250,000. But if your parent has like a rental property or something like that, or a second home, if they sell that home, there's no exclusions except for what they paid and what they put in. They will get hit with that 20% tax bill. Okay, so if that house, say for instance, the profit was $500,000, they're going to owe $10,000. $100,000 in tax. Whereas no, they don't sell it, rent it out, you take over it, whatever, and they die. The day of death, the value of that house is your basis that day of death, basically. So that house can be worth $1 million, but it's zero to you. So if you sell that house the next day after they die for $1 million, that $1 million comes in your pocket. Because your basis is $1 million in the property, whereas their basis might be $200,000. And then it's $800K in income to be taxed capital gains, 20%. So your taxes is a very huge part of your wealth plan because you can transition over your wealth to your children tax-free, basically, or pay less taxes. So that's a very important thing. Don't think that's not a part of your wealth plan. You should have, when you're doing your will, you want your preparer a part of that conversation with that lawyer because they will basically teach you how to basically transfer those assets at death, or if you want to set up a trust, because even though setting up a trust you do with a lawyer, you still have to pay taxes on your estate after you pass. So it's very important to make sure you understand how taxes play into your wealth.
And as I mentioned in the opening, how do you see wealth, wellness, and health tying together for you?
Health, wellness. The biggest thing I would say is two sides is the negative side first. Being broke is stressful, period. I've been there, okay? It is very stressful and it's killing you. So the fastest way to getting rich is managing your expenses and keeping them low. That is the fastest way to getting rich. The biggest advice I can give anybody is keep your expenses low. I make more than a lot of my friends. They all have better places and bigger cars than me. But I am net positive when I sell all my assets, literally, where everyone else is negative. So, my house is a quarter size of most of my friends' house, but my equity has tripled. So when you're making decisions, stop worrying about the Joneses. Stop worrying about what the next person is doing. The only person you ever worry about financially in your life is the person who's paying you financially, basically. If your friends are not paying you to do anything, don't worry about them. So manage your expenses. That's the biggest thing, because once those expenses get heavy, you start getting stressed out. Look at the job wise too. If you save 6 months to a year's worth of your expenses, guess what? That day you walk into work and they piss you off, excuse me, I quit. Because you confidently know I have enough money to cover me for X amount of months. Whereas, if you're stuck in this debt, you're stuck in all these headaches, guess what now? Oh, crap. I got to save this job forever. I'm going to die at this job because, and I've seen it all the time where I've seen, a few years ago at a job, they moved the building. And I'm looking at people 65, 70 with pensions, stressed out. Oh my God, blah, 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 blah. And I'm looking at them like, I wish if I was 65, deuces, I'm done. I'm out. Y'all can keep that other 20% that you're going to pay me in pension. So keep your expenses low. And I know things do come up. Common sense, people have children with disabilities. You might have 2 children that go to Yale. I get it. But in those situations, you just got to kind of live in your means. The positive side is more money gives you better eating options. And that's so, and it sucks because we shouldn't be like that. You know, at one point, we didn't have grocery stores. At one point, we didn't have income, but people didn't starve. So it makes no sense that we're paying, you know, a premium to eat healthy when God already gave us the healthy food to eat for free.
Yeah.
So that's one big thing. Like, you know, managing your income, even if you're low income too. If you're low income, manage your expenses because that allows you an opportunity. You might not be able to buy all your groceries at the organic store or the natural store, but you can buy some of them, especially your meats. You know, like your meats is something, and also too, it keeps you healthy because the portion size you're going to get at the health store is the real portion you're supposed to eat,
right,
compared to, you know, you wanting to save a few dollars at Walmart, you know, and then next thing you know, you're getting this big chunk of chicken breast that's the size of a human being's breast, and getting, you know, all these hormones, and you're wondering why your kid got a deep voice at 6. So definitely, yeah, it's just better options. It really is better options. Don't get me wrong, we all eat bad, okay? Common sense. You give me an option between Frosted Flakes or the health store flakes, I'm going Frosted Flakes, okay? But you can get almond milk with your Frosted Flakes. No sugar almond milk. So it's just really all about, you know, I think to me personally, I keep going back to expenses because that's the killer. It's not the income. A person who makes $20,000 a year with no expenses is richer than somebody who makes $1 million a year with $990,000 worth of expenses.
That's true.
You get my point.
Yeah.
And just an FYI, the more money you make, the more stressful it is. I tell people all the time, I miss being, I was never broke. I grew up middle class. But the less money you have, it's just nothing but up. Whereas when you start getting into higher incomes, you know, I live in $1 million neighborhood right now. And it's amazing. Like, people don't drive Benzes over here because they can't afford them. They drive a minivan and a Honda because that's all they can afford. They are house poor. They're not bringing their sandwiches into work to save money. They cannot afford to eat out every single day. This is a fact. If you don't believe me, come take a walk with me. So when you're making these decisions, understand that in your mind, you think your income is going to go up every year. But ask how many businesses give you a raise every single year. But guess what? You're out here spending, doing things, buying new cars, and your expenses are going up every year. So all you're doing now is just making yourself a long-term slave. That's it. So keep your expenses low. I promise you, when your expenses are low, you're not as stressed out. You know, if that pipe bursts, you have the money. Make sure your credit is right, please. Credit is your best friend. Okay? It is your best friend. It has bailed me out from a lot of situations. You know, don't get a credit card, but make sure, that's another thing too. If you have a credit card and you owe taxes, you are better off paying the tax with the credit card, depending on your APR. If you have a 5% APR, use your credit card to pay your taxes, and then do a payment plan back to your credit card, because it's a lot cheaper paying the credit card than it is the IRS. Because at least a credit card, if you have 24% interest, that's just one thing. Whereas the IRS, you got 25% penalty and then 10% interest every year. So definitely, if you have a credit card, consider using the credit card to pay off the tax bill. And you get it right off, I think, the fees too.
It's good to know because a lot of people may not know that. Okay.
Yeah. You have to itemize though first. So it's not that much neither. Trust me. It's not that great. I like to screw you in a way.
So what else is coming up next for you? What else are you working on?
What am I working on?
More business ventures out there.
You know, honestly, I'm a business person. I love doing business. You know, the biggest thing I'm looking at investing in is I want to get into the weed game. I don't know how. It's probably gonna be as an investor. Growing weed is worse than raising a child. Trust and believe, I've done it before. It's not an easy task at all. I want to get into the weed business for sure. Anybody out there, please invest in weed stocks. It's like the equivalent of investing in alcohol during Prohibition. We are just in the beginning, in the infancy, and there's a lot more to go up. And I do believe as weed becomes legal, I think more people will drink less and smoke or eat gummies more, because honestly, weed is more healthy than alcohol. Looking at, I want to get into the children's business also, probably like, not a daycare, but like a play area, something, kind of like a, what's that place called? Like a kid zone, something of that nature.
That zone.
Yeah. And then like, I'll sneak this in because I'm not a selfish person. There's enough for us to make money. You know what I'm really thinking about? Like photo booths. Okay. Yeah. Social media. I'm like, everybody takes pictures. And, not everybody's rich enough for a background. So I'm like, if you have backgrounds all across different places, or like even like a studio where like people can show up, let's say if you're having a birthday party or something, you want to have a photo shoot. Boom. We have 6, 7, 8 different backdrops. It's like I used to do in the club when we were younger. You pick yours, you take your pictures, you go home. You got kids and you just want to have some fun. Right. Just take some fun pics. So that's kind of in my brain right now. I just got to figure out the business idea. Anybody out there listening, if you take the idea, just give me a little royalty. Just like, I'll take 1%. I'm not selfish. I'll take 1% royalty. That's it. Okay. So yeah, I just planning that I'm doing a project that I'm going to regret. I want to read the tax code. There's so many little things in there that we don't know, including myself as a preparer, because just an FYI, your preparer does not know the entire tax code. There are people who are paying $20,000, $30,000, $55,000 to have a tax return done. Okay, I'm talking about some people pay $55,000 just for a phone call. Okay, you have people who literally are getting paid 6 figures working for a Big 4 accounting firm, and they only focus on one tax code. One. So be aware, your tax preparer does not know everything, including me. Vet them. Make sure if you have something specific that you need to benefit from, actually prepare, have they done it before? Like prime example, we have the qualified opportunity zones going on right now. Guess what? That's new to all of us. So we're all kind of learning that right now. But then you have other things like, qualified high technology companies, things like that. So you have to make sure your preparer knows that. But yeah, so I do want to read the tax code just to kind of see where to find those different special, I think we talked about this before, like prime example, the conservative easement, where Kanye West owns thousands of acres of land in, I think it's Oklahoma or something like that.
I think Wyoming.
Yeah, Wyoming, there we go. And he doesn't own it because he likes land. He owns it because he gets a write-off up to 50% of his income for conserving that land and not using it to build homes, drill for oil, and things of that nature. So by him conserving our beautiful, lovely America, they give him a tax write-off for that. So, those are those little things that I want to be able to give to the small business owner like you, because when you start getting to that $1 million, that $10 million, you should already be aware of where your money should be moving and how your entity and how your business is set up so that you're paying the least amount of taxes.
And how can someone reach you for services? Because you just gave a whiff of information, and I'm sure they're going to be like, where can I find him? Because I need to know.
Definitely feel free to reach out. Make sure you say this podcast, because I'll definitely give you a discount. Say the podcast. You can social media. I'm on Facebook, Instagram, but please don't DM me. I don't check DMs that much. I'm old. Facebook and Instagram at Chedick Financial. That's Chedick Financial for both platforms. Same thing with LinkedIn, Chedick Financial. Or you can email me directly at chedickfinancial@gmail.com. Do not spam me. I'm just going to delete it. Okay. Don't send me your business idea. I'm going to delete it. If I don't know you, I'm not going to entertain it. Again, it's chedickfinancial@gmail.com. That's Chedick financial@gmail.com. So definitely feel free to reach out. I'm all about educating others, especially small business owners, individuals. I'm about the small guy. I have no big interest in working, doing taxes for GE and the multi-billion-dollar companies. I'm more worried about the small guy who doesn't understand and needs to learn. And then the day when you become the GE, I'm right there with you.
Well, right. I thank you so much for your time in educating and advocating for people who don't understand taxes and new business owners. It's definitely important. Again, wealth, health, and wellness all ties in together is very important because a lot of people have committed suicide because their money wasn't good. So definitely there's many financial resources out there. Please use Google, research those to get the assistance that you need if you are in financial debt or if you need more education when it comes to your taxes or anything else. It's too many resources out there. So please take the
And
time.
there's no stupid questions.
Right. And definitely it's not, don't be embarrassed because this is to help you in the long run, to help your family, to help you financially, to become financially healthy. Because again, your wealth starts with you and then it delivers over to your money. So thank you so much, Cecilia June. Thank you, Patrick, so much for joining. And
Thank you
until
for
next
having me.
time, would love to have you back on some further stuff that you got going on.
Definitely let me know. I'll be more than glad. That was a great experience. Thank you so much for having me. I appreciate it.
All right. No problem.
All right.